Thanks for the opportunity to present here. You've been working with GMEBs for a couple of years, done maybe 35 GMEBs valuations in the last couple of years. So I am familiar with most of you on the line. I think I've spoken to all four of you currently on the line, and glad to have a chance to talk through some of these changes with GASB 74 and 75. I'm not an accountant, I'm an actuary, so take what we're presenting on faith as from an actuary. So I am familiar with the new accounting statements, GASB 74 and 75. And I'll be walking through those with you, but again, not an accountant. I have, however, been doing OPEB valuations for 27 years now, so I'm fairly familiar with the way that the liabilities are calculated and have a good feel for the way numbers should move. As far as accounting goes, as far as questions go, I see most of you, I see we have a couple new people online, but most of you have used the chat box already and have stated the city that you're in. If you have a question, type it in there and I'll try to add some clarifying remarks regarding this. When we're done recording, I think at the very end maybe we'll have some back and forth where we can talk after the presentation if you have some more specific questions with regard to your specific city. With that, I'm going to go ahead and talk about what we're going to do today, which is basically talk through these three issues, that what GASB 74, 75 is, and then what some of those implications might be. So when we presented this internally, one of our young analyst said, oh, so this is like GASB 68, but it's for OPEB, and that's probably the clearest and cleanest explanation of what GASB 75 is. It is like GASB, moving to GASB 68. We get all the time, why? Why are we doing this? And are we changing accounting standards from 43 and 45 to 74 and 75? The summary of GASB 75, and by the way, GASB 75 is 310 pages long. But the summary says it's for increased transparency. And internally at Segal, we've been talking about what does increased transparency mean. And we have decided that it has to do with readers of the CAFR and financials who want to check out your ability to borrow and really kind of differentiate between how the OPEB liabilities should be reflected in your net worth, if you will, or your ability to pay long-term debt, which the OPEB plan essentially is. One of the highlights to this is, and just to show how dramatically different some of the liabilities are for some of the government entities that we face and we talk with. There was an S&P state survey in 2016, and again, just to highlight how big a difference some of these liabilities are across states, which again translates to cities, is there were 4 states with between $70 billion and $85 billion in unfunded actuarial accrued liability. The next highest state had about $35 billion in unfunded liability. So the 4 highest after that were from between $20 billion and $35 billion. Now, obviously, that's almost $40 billion between the top 4 and the next 4. And that kind of highlights how big a deal and how different some of these liabilities can be for individual cities and states as well. just to conclude the averages for the state plans, we see the average was 12 billion, but the median, that means there are the same number above as below, was 3 billion, and there were 16 states with less than $1 billion. So using the state analogy, let's apply that to cities, and we can see that some of the cities in GMEBs have liabilities as high as $35 million or more, and lots of them have no OPEB liabilities, and there are a tremendous amount with fewer than $1 million in liabilities. What all this means is that GASB 75 wants to put that information into your CAFR so that it's done on a consistent basis and really help identify what the long-term ability of the city is to contribute or to have these, to deal with these long-term obligations. Ultimately, that affects the ability to borrow. And let's see, S&P in fact came out with a new statement in December of 2017, the rating methodology for government entities, and it did include information about how they were going to treat OPEB liabilities. So now we're going to focus not on the why so much, but how are we going to implement, and with that we're going to start with evaluation. So what goes into evaluation? And I wanted to at least walk through some of these things that have changed here in the last 5 years. Starting on the left, the GASB rules are changing now. We're going from GASB 43 and 45 to GASB 74 and 75, which is a fairly dramatic change. With the ACA and some of the specialty drug implications, the substantive plan, the plan maximum is changing, the out-of-pocket maximums are changing, and so we're seeing big changes there with regard to the plan provisions. The federal and state requirements haven't changed that much. However, your CAFR is changing, and so what goes into the CAFR is changing. For member data, we're not seeing that much of a change, though we are focusing more on who is eligible for social or Medicare benefits, and there's been some movement along those lines. There's also been some movement toward, on the pension eligibility side, you know, are the pension benefits the same? Are we, if the pension benefits change, what does that do to things like incidence of retirement in the OPEB world? As far as budgeting methods, we're going to change the actuarial costs method for expense purposes, and that might translate into something on the budgeting side. But there's additionally some more entities are now funding their OPEB liabilities because of some of the incentives in the GASB 74 and 75, and we'll talk about that later. The financial data and funding policy, again, the S&P ratings methods are changing, and we're going to have to change some of the what goes into the CAFR, and we might, with regard to the change in the changes in GASB 74 and 75, the funding policies might also change. Our claims experience is interesting, and in particular with the plan maximums, and we're seeing some entities going to that are self-insured. They're getting more stop-loss coverage, and specialty drugs has been a big deal in the last 4 or 5 years. Medicare provisions, the excise tax was part of the ACA, and that is going to have to be reflected. It's never been reflected before in our OPEB valuations, and now we're required to reflect the fact that it's supposed to come into play now in 2022. And then actuarial assumptions, we've had low discount rates, and we've had high medical trend rates, and those two combine to make for big changes. So the bottom line here is, with all of these changes going on, our liabilities, our OPEB liabilities, are moving around quite a bit, and we're trying to figure out, well, what's the end result, and how has that impacted various plan sponsors? And here are some of the ways that it impacts plan sponsors, some of the repercussions, if you will, from all of those changes. And you can see that CAFR, some of those, the CAFR will be impacted. We're seeing plan design studies, that your expense is going to be changed, maybe your contribution policies, your budgeting might change, the allocations to various groups might change. It could impact your bond ratings, the cost of capital, and employee cost sharing. So all of these things could be impacted by the changes that we've seen over the last 5 years. So if there are any questions about these couple of slides in the background, let me know. Otherwise, I'll continue to move on. All right. So today, what we're going to talk about is GASB 74 and 75, and that's going to be the bulk of the major focus here. Then we'll talk about some of what other employees are going, what other public sector employers are going to do. So GASB 75 applies to all plans and plan sponsors. So this replaces GASB 45, which went into your CAFR. It deals with employer reporting. GASB 74 is for plan reporting. So if you were funded and you did a plan audit, then GASB 43 applied, and it applied to pre-funded plans. The effective dates for GASB 75 is if you have a fiscal year that began after June 15, 2017, including short fiscal years, or ends at June 30, 2018 or later, then you're going to have to state on your CAFR for that year under using GASB 75. If you have a funded plan, if you have a trust, an OPEB trust that you put money into and pre-fund, then GASB 74 will apply for fiscal years ending June 30, 2017 and after. There are just a few, I think there are about 3 or 4 GMEBS plans that are pre-funding. So GASB 74 is not applying in most instances. And we'll talk some more about the implementation dates and when you need a new evaluation and some of the disclosure dates in a bit. As far as GASB goals here, we did a practice run yesterday. They said I spent too much time on this. So let me have you walk away with just 3 things. We're trying to balance the cash costs of having this plan, the benefit promise that is there and inherent to our employees, the employer-employee benefit promise, and the difference between accruals and cash flows. So GASB is designed to, the goal here is to try to balance those 3 items and in particular highlight the difference between accruals and cash. On the financial statements, we're going to see some changes here. So the first bullet point is certainly their main objective is improve accounting and financial reporting for the readers of your financial statements. The second one, the word here is entities, and some entities these are not your employees, but they may be in your employer plan. The example that I have and that we deal with typically is with the city of Birmingham has sponsors the pension plan, and they have their airport authority, which is a separate employer. It participates in that pension plan. So that's a separate entity that is part of the employer plan. I don't believe we have any in GMEBs. If you have a separate entity that is participating and contributing toward the benefits in your plan, we need to know about it. But at this point, I'm not aware of any other entities along those lines. Let's see. The last thing I want to talk about here on this page is the established standards. Well, they really just stole the standards from their GASB 67 and 68. So these are very similar to the pension standards. There are a couple of minor differences, but we'll talk about some of those later. GASB 45 was a funding-based policy. So when we calculate your GASB 45 expense, we start with the actuarial required contribution, which is a funding type of amount. How do we go about funding this plan? GASB doesn't do anything along those lines. It doesn't try to be, GASB 75 doesn't try to do anything along those lines. It's trying to show the difference between the accruals and the cash flows. And so what we're looking for here is that it's different. And so that's why funding policies may need to be addressed because GASB 75 doesn't inherently include in it any funding policies. And we'll talk a little bit more about funding policies later. Here the focus is on financial implications. The focus is on an OPEB valuation that in an attribution of expense. So we're going to focus on the net OPEB liability and OPEB expense. That's a change from the net OPEB obligation. The net OPEB obligation is going to be replaced by the net OPEB liability on your statements, and there's typically a pretty sizable difference between those two. And it will go on the books and is a more volatile expense. Let's see. We think that there's going to be an increased requirement for timing discussions between the actuary, the city sponsor, and the auditor with regard to when valuations are needed and when disclosures are required. In general, we're going to try to develop a standard that will provide you with your disclosures before fiscal year end, and we'll talk some about timing later. This last bullet point here is there is, because with the movement to this total benefit liability from the footnotes of your financials onto the books as an actual item, we are seeing a cutback on benefits in lots of entities and a desire to pre-fund for those that remain. So I think this is kind of highlighting the difference between expense and cost, and when the difference is dramatic, there's an incentive to provide cutbacks. And we're not suggesting that you do that. It's just that that lots of our entities are concerned by the amount that's going to flow through on their books. The change to GASB 75 will result in a restatement, and I'm not going to go into what paragraph 244 actually says, but we've had a number of entities try to say, okay, where are you getting this? Why does it say restatement? Where does it say that? And so these paragraphs below here identify that for us. New assumptions and methods. We're changing the funding method from projected unit credit to entry age normal, and we'll talk a little bit about that. We're also going to blend the discount rate. So if you had a 4% discount rate in the past, that's going to be replaced by a bond rate. If you were funding and had a longer term discount rate, we might use that same rate, or we might blend it. We'll talk a little bit more about that here in a moment. Entry age normal is a change in the funding method. In general, liabilities, the accrued liability will go up, and the normal cost as a percentage of pay will be less volatile. That's in general. The market value of assets, there's no more smoothing in the net pension liability. The amortization methods are going from what is essentially in a very long, somewhere between 18 years and 26-year amortization of changes to something that's incredibly short, either immediate in some instances and up to, seen that's somewhere between 4 and 8 years in most others. So there's a big change in the way that we're amortizing things. Ultimately, we're going to see some more volatility in your expense and a bigger number on your balance sheet. So as far as the discount rate, who gets the long-term rate of return and who gets the municipal bond rate? If you have a funding policy and you're pre-funding, you'll get this long-term rate of return, which is calculated now in a different manner. And then if you're not pre-funding, you're going to get the municipal bond rate. That's currently about 3.45%, according to that's at 12/31/2017. So if your liabilities were calculated at 4% in prior valuations, they'll be calculated at something less than that now, based on the changes in the municipal bond rate. Again, about 3.44% at 12/31/2017. So when the discount rate goes down, liabilities go up, and I'm not sure anybody wants the larger liabilities other than the accounts. So what happens if you're in the middle? We get there's a process that goes on, and you get a blended rate that's somewhere between the long-term rate of return and the bond rate. The long-term rate of return is actually a calculated number based on how well funded you are, and if your funding policy has the ability to cover projected benefit payments in the future, then you've got if that's the case, then you'll use the long-term rate. If you have some assets, but you're going to run out of assets at some point in the future, you'll use a blended rate based on the long-term rate, which is usually about 7.5%, and that bond rate, which is about 3.45%. If there's any questions about the discount rate, this is a good time to ask them. Seeing none, I'm going to go ahead and continue. I'm going to breeze through this. This is another item where I spent a little bit too much time, but bottom line, there's going to be generally greater actuarial accrued liabilities and a less volatile normal cost as a result of these of the change from projected unit credit to entry age. Entry age tries to generate, the goal of entry age is to try to generate a level normal cost as a percentage of pay throughout an employee's lifetime. So that's the general idea. In projected unit credit, the normal cost increases as a percentage of pay throughout a participant's lifetime. So in this instance, the normal cost or the service cost as as it's called under the new standard, we're seeing a better movement toward less volatility, though everything else will create more volatility. The total OPEB liability, that's the new actuarial accrued liability defined in the term under GASB 75, will also reflect a couple of other changes. The excise tax actually just got deferred. It was deferred to 2020 until Monday of this week. It got moved to 2022 with the budget bill. And so we are seeing that it will have to be reflected in your benefit liabilities, but it is deferred out there in the future. The second bullet, we are required to allocate higher costs to older ages, with the average being in year one being the same, but there's a growth in liabilities that's attributed to allocating higher costs to older ages that we reflect in these closed valuations. And so we're required to do that. And that's been around for a little while. If you've had a valuation done in the last 2 years, we've been reflecting that, but that's a 2015 valuation responsibility or requirement. Trust requirements, I'm not going to go to into these very much either. They are similar to those for pension plans. Revocable contributions. GMEBs can administer an OPEB trust. Currently has, I have here 3 cities pre-funding. Is that right, Mike? Yeah, Mike.
Yes, that's correct.
Okay, so if you're looking for an avenue to pre-fund, we have trust agreements set up and ways for you to do that. So now we're going to talk for the next 3 pages specifically about the GASB 75 expense. The last page we will compare to the GASB 45 expense. So this is, I guess, where the bulk of what's going on here and the biggest concern for participants, for our plan sponsors. So that on at the current period normal cost, I guess that's right here. The current period normal cost is, our service cost will be recognized immediately. So these are the items, this is the immediately recognized page, and then the next page we'll talk about deferred items. But so we're going to start with the service costs, and this is the total OPEB liability, so that's the benefit liability side. We're going to recognize the current service cost, and then the interest on the beginning total OPEB liability. Both of these are immediately recognized, and it's not that different from what's going on currently in your valuations. But this one, we've gone from a long amortization period of recognizing changes in benefit terms or changes in plan provisions, if you will, to an immediate recognition of these changes in benefit terms and plan provisions. So with that being the case, and with an immediate recognition there, again, we have an incentive to cut back on benefits and a disincentive, if you will, to recognize them immediately because of the way that flows through expense. When I say immediate, I mean during the fiscal year. I don't mean like if it happens in May that you have to make a change in May. It's recognized in the expense during the fiscal year. The changes in plan fiduciary net position. Plan fiduciary net position are for plan's assets. And so these items are also immediate. It's the projected earnings on plan investments. That's an immediate recognition. And then some other things, in particular the admin costs and some of the other net changes that might happen during during the fiscal year in assets, and we're recognizing that in the on the asset side. Typically, that's just admin expenses. The deferred amounts appear here, and on the left-hand side here, this left, on the left here, we're going to defer a great portion of the actuarial gains and losses and changes in assumptions. These are being amortized over the average future service of your participants, but we're counting inactive participants, that is retirees, as well as active employees, with the retirees having zeros. So if you take the average future service for your participants, and then change the denominator, if you will, to include the retirees, you get a relatively short number, and we're typically seeing between 4 and 8 as the amortization period. For some closed entities where there are only retirees, and I think one of you on the line that applies to, where there's going to be an immediate recognition of actuarial gains and losses and changes in economic or demographic assumptions. Those are recognized. Those will be recognized immediately if you have retirees only in your liabilities. So these changes in the past would have been recognized over somewhere between 18 and 26 years, depending upon your amortization method. And now we're going to be replacing them by a much shorter amortization period. And this is where we are developing the statement that indeed we're getting a shorter period and more volatility in our expense. So these differences are the changes in the plan assets or the plan's fiduciary net position, and those are always over a closed 5-year period. So again, these were recognized in the past as over a 26-year period, or between 18 and 26 years, and now we're going to recognize over 5 years. So with that, you can see that these two items are going to provide a much greater volatility in expense. A couple of other things that I wanted to point out on the prior page. We've got interest here on the beginning total OPEB liability. If you're not funding, that's going to be at the 3.45% that I was talking about, the municipal bond rate. Or if you are funding, it might be based on something as high as 7.5%. Over here, this is just going to be based on that 7.5%. So if you have a blended rate, this will be based on the blended rate, and this one will be based on that larger rate, that higher rate, 7.5%. So the projected earnings on plan investments will be based on that higher discount rate that's more dependent upon what the assets are. Lastly, after this next page is a good time to stop me with any questions about these expense items. So after this page is a perfect time to ask your questions about the expense. And we're talking about the current OPEB expense, and on this side, and we're going to compare it to the new OPEB expense. So it started out with the ARC calculation. That's something that you're familiar with, the annual required contribution. It's been in your reports since GASB 45 came out around 2006. It's a normal cost plus a period and amortization, which in most instances was a level percentage of payroll amortization, so it was over a relatively long period, but typically, or the amortization periods of the unfunded actuarial liability, that's what this is, the unfunded actuarial accrued liability, was over a period of 18 to 26 years. That was the funding policy type calculation. There is an ADEC in the funding policy, and if you have a funding policy, which was this funding policy, we're going to go ahead and continue to calculate that. You can change it if you like to something different, but we're going to continue to do this calculation. But it doesn't flow through and get included in the expense at all. So we have the ARC here, and with the ARC we added interest on the net OPEB obligation, which was your GASB 45 booking entry, and then an adjustment to the ARC. And so that's annual OPEB cost was developed. Now you'll see that there is no reflection at all of the funding calculations. We're going all with expense type calculations. So we're going to use a service cost, the interest on the OPEB liability. We're going to immediately reflect plan changes, some other net changes and plan net position, and then we're going to have some deferrals. So we're going to recognize some portion of investment returns, 20% of investment returns over the expected, and then we're going to recognize changes in assumptions, differences in expected and actual experience. That's what we call the gain and loss over a longer period, somewhere between 4 and 8 years. So if you have any questions, now is the best time to ask them. We're going to walk through an example here in a couple of pages. All right, we'll wait for the examples. Maybe they'll help clarify that. So deferred recognition is next, and what we've got here, if you use a 30-year 4%, 3% payroll growth amortization period, you had a 26-year deferral of bringing in actuarial gains and losses. As we've discussed before, it's going to be rather short, somewhere between 4 and 8 years in the new accounting standard, and the difference between actual and projected earnings year over year will be a 5-year period. So again, shorter recognition. So how does this work? We'll talk about that in just a minute or two. We're also going to have something, if we're going to defer something, we have to have a bucket to throw it in, because the net OPEB liability is what is going on your books, and this deferred outflows and inflows of resources related to OPEB will be the bucket that catches all of that stuff. And the example is, if we have average expected remaining services 6 years, 1/6 here, this third bullet, 1/6 of the demographic actuarial gains and losses will be recognized immediately in OPEB expense for the year. The remaining 5/6 is going to be recorded as a deferred inflow and outflow. So that's kind of the way this is going to work. Again, I'll have an example on the next page. So included in this this change are the changes in discount rates. And remember, if we're going to refer to the 20-year municipal bond rate as the discount rate for unfunded plans, that moves around typically every year, and so every year we're going to have a change in the discount rate, which means we'll have to do separate disclosures for you. While you do an annual while you do a valuation where we collect participant data every 2 years, in the interim year we'll have to do a disclosure as well that reflects the new bond rate. You don't have to collect new claims and participant data every year, but we will have to provide an interim disclosure for you that will highlight what the changes in discount rate at least are. On the investment gains and losses, we're going to do the same thing. So if you're funding your plan, we'll also, in those interim disclosures, have to recognize the gains and losses in the year, collect financial information every year. But instead of using 1/6, we're going to use 1/5 and recognize some of that. So what does this look like? Well, we're also, I guess we finished this up before we have our examples. We're going to have expanded employer disclosures that are going to be required. Their description of the plan and assumptions, the policy for determining retiree contributions. So these two items are, well, we're going to have a bunch of tables for you that we'll provide in our actuarial valuations. There are going to be some other things that you're going to have to collect. And these first three, the description of plan and assumptions, well, we typically include that in our valuation reports. We don't talk about the policy for determining retiree contributions or authority for changing the plan. Those are highlighted in these paragraphs at the bottom of GASB 75. We're not going to be collecting that information from you. We're expecting the plan sponsor to know who this is. But I would suggest that if you're an HR person, that you point out these provisions and these paragraphs to your finance people and make sure that they're on the ball here with regard to getting this information into your CAFR. We'll provide you with the sensitivities. There are tables for those in the standard disclosures. We'll set up tables for you for the net OPEB liability for the past 10 years. The development of the long-term earnings assumption. If you're funding through GMEBs, we will have a standard policy that includes the discount rate. It's very similar to what's done for the pension plan. It's the same investment policy as for the pension plan, and so we'll most likely be stealing a lot of those same items in our standard reports, but we'll provide you with this information if you're funding through GMEBs. If you're not funding through GMEBs and you are setting up a trust, please let us know, and we'll deal with that as a one-off kind of an idea. If we're calculating the actuarial determined contribution, and that's the prior arc is what we're assuming that you're going to continue, then we must disclose a 10-year schedule. We're seeing a lot of auditors ask for this even if you're not pre-funding. The readers of financials like to see, okay, how much would it cost to shift to a pre-funded plan? What's the difference? What is that gap between a funding policy and the cash that's actually flowing out of the plan? And so we're seeing many auditors ask for this even if you're not pre-funding. And then there's some additional information about plan governance that's in here. In particular, if something has happened after the measurement date and prior to the reporting date, there's some additional information about what's going on there. That's going to be required in your CAFR. So let's move on to a little bit more. This is the long-term rate of return, and again, we talked about that already. But these are some of the items that are required actually in the CAFR. As far as our example goes, this was under the prior funding accounting method. This is under GASB 45, and this is a chart that you've seen before that had the valuation date, the fiscal year, and your ARC, if you will, the annual required contribution. This was the NOO, the prior NOO, and this was the interest on the prior NOO. The ARC adjustment had to do with the prior NOO and how that actually went into developing the annual OPEB cost here. So the actual amount contributed, and you can see this plan is pre-funding, generated a negative net OPEB obligation, if you will. They had been funding more than their expense. On this page, you can see the new, this is under GASB 75, and this will be a change. And these numbers are highlighted for a reason. They'll be used in your opening on this page. This number, this net OO, as of, in this instance, 6/30/17, will appear in your accounting entries with the change over to GASB 75. Here, this is actually a page that will be, a table that will be in our current GASB 75 reports. It will also be required in your CAFR under GASB 75 disclosures. So we walk through the total OPEB liability, the value of the assets, and the net amount, and the planned net fiduciary net position, or the assets as a percentage of the total OPEB liability. This number is based on a reporting date of June 30, 2017, and so the changeover from this number, which is the net OPEB obligation, is the negative 635,880, to this positive 2.5 million is going to appear in your journal entries.
And David, let me stop you right there if you don't mind. If you can go back to that slide. And this information is information that has to be disclosed annually on their CAFR, is that correct?
Yeah.
And they will require some additional reporting from Segal with respect to updating the annual CAFR, is that correct?
Yes. So for some entities, thank you, Mike. For some entities, and I went back to the GASB 45 page, we updated these entries for you annually, and we did an interim disclosure for you, if you will, and provided you with a new ARC in some instances, but in all instances, a new annual OPEB cost. Here you can see they kept the same ARC through the year, but the annual OPEB cost changed. Under the new accounting standard, you can't keep that same expense from year to year. It's going to vary based on the discount rates and possibly some assets if you have them, and possibly some plan changes. So with that, we're going to have to provide you with a new disclosure every year. And Mike's exactly right. So you don't have to do a full valuation every year. You only have to collect data, both participant data and claims data, every other year. But you will have to go through and have an annual update every year. That's this interim update. It's very similar to what we did for GASB 45. This is actually the GASB 74 chart, but I have the GASB 75 labels here. So this is a change in total OPEB obligation, total OPEB liability here, where we start with this beginning liability, then we have all of these changes flow through in the ending liability here. So as you can see, here's the service cost and the interest cost that we talked about. There were no change in benefit terms. So it's a roll forward, so we didn't have any difference between actual and expected experience. We did change some assumptions here, so that gets a separate treatment. We had some benefit payments, and that net total was the difference here. On the asset side, we have a beginning asset value right here, and some of the changes that went on. Employer contributions here, employee contributions, and let me say here, these employee contributions, we've had some plan sponsors ask if those were the retiree payments for the premiums, and the answer is no. These are for pre-retirement contributions. In rare instances, we have some entities that are charging their employees while they're active employees for the OPEB plan, kind of like you do for the pension plan. And so those employee contributions would go here. The retiree contributions toward the premium are not included in our liabilities, and so do not get reflected here at all. The net investment income goes here. That's the net investment income. We'll talk about none of this is expense just yet, but this is how we're changing liabilities and assets during the year. So this is the net investment income. Again, the same benefit payments are up here, and the administrative expenses, and these were the changes in assets here, and you can see that flows through there to the 763,000 was the beginning assets, and the 853,000 was the ending assets. So the net OPEB liability is determined as the difference between this ending amount and this ending amount. You can see that's 2.9 million here, and it was 2.5 million here at the beginning of the year. That relates back to that 2.5 million here and that 2.9 million, these two numbers that appear here. So we go through and we have this single page that talks about here. This is what here's what those liabilities are, and then this page, and this again will be a page in your report that talks about here are the changes that happen from year to year. These other items, this covered payroll and net OPEB liability. So we do need to collect some payroll information, as all of you are participants in the pension plan. We have that covered employee payroll. Now, if it's different from what we use for pension, please let us know. Or if the pay is different for the active participants, include them, let us know. But we do calculate this net OPEB liability, that 2.9 million divided by this $10 million is where that 28% comes from. Still no questions, so feel free to jump in if something's not clear. All right, so we did have changes here. We had a $264,995 change in assumption. And on this net deferred outflows pages, we have 231,868. So why isn't that the same as this number? Well, we look here, and the calculations are done here. So we have 264,995 was the change in assumptions. Their average future service in this instance was 8 years, and it resulted in 33,000 being recognized immediately, leaving $232,000 to be deferred, and that's what goes here as a deferred outflow. Likewise, there was a change in assets. There was an asset gain, and so there was a change in assets that was different from what was expected, and so that flows here. I think they had an asset loss, and so that's what happened here. So this is the expense that gets recognized. We have the service cost. We have the interest on the total OPEB liability here. That's based on the beginning of year OPEB liability and the beginning of year discount rate. Both of these are beginning of, these are calculated as of the measurement date here is June 30, 2017. So these would be calculated as of July 1, 2016, and July 1, 2016 for this measurement period, which is June 30, 17, and it will go on the June 30, 2018 books. We'll talk a little bit more about some deferrals there, but when the discount rate is changing, that's what's going to happen. We talked about the expense portion of the current period changes was about $33,000. That relates to these calculations right here. Again, that's 1/8 of the changes in assumption pages. We had some projected earnings on plan investments and some expense portion of the current period difference between actual and expected amounts. Let's see, administrative expense is recognized immediately to develop this total OPEB expense. So this is the calculation, and again will appear as an item in your reports or in your interim disclosures as well. So those are the expense calculations. That's kind of what will go on your books. There are no questions, and I'm not seeing any. Let's talk about the types of plans and timing. So the types of plans, there are three different types of plans. There are, and I think for GMEBs, we're going to hold this to just a quick page to discuss some of those single employer. Most of the plans will be single employer plans. You might have an agent multiple employer plan. If you do cost allocations in your CAFR based on the liabilities that you've been using for GASB 45, please let us know, because we're assuming that there aren't any other entities, if you will, that are contributing or any allocations that you have. The allocation process under GASB 75 is not pretty. It wasn't designed by somebody who actually had to do those calculations. As far as timing and frequency, the next 3 pages talk about timing and frequency. The thing that I want you to remember most is that within 30 months and 1 day of evaluation date, you can have that valuation applied to the CAFR. So if we've done a valuation as of January 1, 2016, we can have that appear on the June 30, 2018 CAFR. We have to change discount rates, and we have to do some additional work to get those numbers, but we don't have to collect new participant data, and we don't need new claims data to do that work. So the measurement date can be earlier than the fiscal year end reporting date. What we're suggesting here is a year deferral. Most of our clients are going with a year deferral. So some are looking for shorter periods than that. It's quite convenient to have the measurement date actually match up with the fiscal year end reporting date, though a year before. So most of our clients are either doing at the same date, that the measurement date and reporting date are the same, or they're doing a year lag. Again, the 30-month rule here, highlighted here as far as the OPEB liability goes. The asset component must be as of the measurement date. If you were doing actuarial valuations every 3 years, they're going to be cut down to every 2 years by this 30-month deadline. So that they have to be every other year at least. And let's see. So differences between the actuarial valuation date and the measurement date can be included in the tables that we send you. If they're between the measurement date and the reporting date, then they can go in the verbiage that accompanies those tables. But we're not supposed to change the measurement, the liabilities calculated as of the measurement date. And that goes into these are some of the factors. Bottom line here is this maximum 30-month rule that I think is you can't have more than 30 months from the valuation date to the reporting date. Have a chart here that kind of identifies that. Again, if you have a 6/30/15 valuation date, then the reporting date for GASB 74 can't be more than 2 years out. It's 24 months. But for the GASB 75, you could use a 12/31/15 valuation date and report on it at 6/30/18. So that's 30 months in one day. So that kind of gives you an idea of how long, what the cap, what it's just pictorially of what's on the other page. So we can go from a January 1, 2016 valuation is sufficient to provide information for a June 30, 2018 CAFR. And we are suggesting this 1 year lag just because it's so much easier to gather information. If you want something different from a 1 year lag, please let us know. So let's give some specific examples about fiscal year ends. If you have a June 30 fiscal year end, then June 30, 2018 is when you will have to incorporate changes to your CAFR. June 30, 2018. And so the January 1, 2016 valuation can be used for the June 30, 2018 CAFR, but it can't be used for 2019. We'll need to do a January 1, 2018 valuation, and that will be good for 2 years. If you've done a January 1, 2017 valuation date, it can be used for both the June 30, 2018 and June 30, 2019 reporting. So depending upon when your last valuation was, and we have that information certainly collected, we can you can have reporting go 2 more years. If your fiscal year end is December 31, then you don't have to put, we're not anticipating putting January or GASB 75 information on your December 31, 2017 CAFR, but we're going to wait till December 31, 2018 to provide you with that information. If you're funding, you'll need to get some GASB 74 information, but I don't think anybody is currently doing that. That's on the phone. I don't think anybody's currently there. Lisa, I see your question about September 30th end of year. We will, you'll, again, if you have a, I can't recall what your evaluation date is. If you have a I can't remember if it's a July 1 valuation or a January 1 valuation, but again, the 30-month rule applies. If it's a July valuation, you're fine. If it's a January valuation, we might have to redo it. So that's kind of the issue around measurement dates, and we'll Lisa, I'll touch base with you after. There aren't many that have fiscal year ends other than June 30 and December 31, so I'll touch base with you after. So with that laid as the background, we're going to talk a little bit, and I have about maybe another 15 or 20 minutes of slides to go through before we're done here, and we can take some questions after. Some of the issues that we're seeing with regard to this are that we're going to have a bigger expense, a more volatile expense, and we're going to have a bigger balance sheet item on the books, and that's a huge deal. For most public employers, in particular, it's going to impact their ability to borrow, we think. In particular, some of the states, and remember I was talking about those 4 states that had more than $70 billion in benefit liabilities, that they're going to have some issues with regard to future funding of those liabilities. And so they are actively looking at ways to reduce those liabilities and dedicate funds to them. The accrual statement of net position will add putting that net OPEB liability on there is a large unstable element. So we typically have, for one entity, we had 7 different items in a year that were more than a 5% change in their benefit liability. Now, in this instance, 3 were positive and 4 were negative, but the fact that there are so many things that impact OPEB liabilities, and because their duration, if you will, is so long, any small change can have a big impact. So what I mean is, we have a lot of pension plans have a COLA, and we have in lieu of a COLA, we have a medical trend, which is typically a good bit higher than the COLA on your pension liabilities. And because of that, the benefits at the tail end of the expected payments aren't discounted a lot. They're, the difference between the discount rate and the medical trend rate means that we're not discounting those liabilities very much. And so with any change in claims or any kind of change to the out-of-pocket maximums or the participant group covered or the retirement rates, those are all bigger changes than on the pension side. And so we're seeing increased volatility will be added on this, on the entity that replaces the balance sheet here, because we're putting the entire net OPEB liability on the books. The unfunded nature is also a bit of an issue. New Jersey, for instance, had about $85 billion for OPEB liabilities and pension liabilities, but it had $50 billion in pension assets. It has nothing for OPEB assets. So the fact that these liabilities are unfunded means that they're going to be based on a much lower discount rate, and they will stand out on the balance sheet. Any questions there? Some of these issues, how are we going to be able to raise funds? Will it impact our ability to get cash to fund new infrastructure and new initiatives that we might have, or even, you know, we were talking with Segal was talking with Houston and trying to figure out, well, will the OPEB plan help impact their ability to recover from the hurricanes? And it's a huge deal there. We think it might impact bond and credit ratings, so to the extent those are a big deal, we think that identifying and at least recognizing that the OPEB will have a bigger impact on these liabilities than it has in the past. Some trusts, again, not many plans are having trusts, but the GASB 74 had some new language describing the way the trust must operate, so we're suggesting you have that looked at if you're funding outside of GMED. And then cost allocations are, my son's studying for the SAT, and he used the word lugubrious on me the other day. It means dreadfully mournful, and that's kind of how I view these allocations here. The opening of balance adjustments we're going to talk through here in a moment. The example, based on the example that we had. This talks about applying and complying as an adjustment to prior periods. That means restatement to me, and presented for periods affected should be restated. And it's not, nobody is going back, nobody that we have seen is going back and redoing this from a particular point in time. So it's all a perspective kind of change, and creating new deferred inflows and outflows and going back 7 or 8 years to do that is just something that we're not seeing. And again, not required to state comparative information in the MD&A. Moving on, here's how I talked about the adjustment to the beginning of balance. So the net OPEB liability, and again, that was in our examples. Right here, so this number is 635,880 now is going to appear here on the GASB 45. GASB 45 line, and then this net OPEB liability, which appeared here, this 2.5 million dollar number will appear here. That's the net OPEB liability, and this balancing item is the difference. So this is the journal entry that we've come up with. Again, I'm not an accountant. These are stolen from some GASB 68 pages and the GMEPS accounts. Looked at them and seen that they agree that this is what we think is going to be the way that you're going to do that opening entry. And note that this is at the beginning of the period, so that's how we're going about this. Let's see. So that's the opening balance adjustment and journal entries. So what are employers doing? Here's some of the responses that we've seen and some of the things that we've been looking at. They are going to compare costs to the prior accounting standards and collecting new data that will be needed for the valuations. So if that includes the going back in the governance items that will be required, GASB 75 items. And again, look at those paragraphs in GASB 75, that's paragraphs 50 and 58 for collecting some of that new information. If you have cost-sharing plans and plans that allocate to various employers, then be sure to collect that information as well. Let's see. The discount rate development, if you're interested in funding, taking a look at some of the things that happen and some of the good things that happen when you can get a lower discount rate with regard to your plans. We've done some work with Cumming recently. They started funding and they reduced their liability significantly. Many are reviewing their funding and investment policies. We're seeing some forecasting by typically larger entities are doing some financial forecasts. If you're funding, they're reviewing the trust document. And then, again, the new disclosure items related to plan governance that are being reviewed and looked at. Some of the benefits studies that we're looking at, the eligibilities, the cost sharing, some of the designs and the out-of-pocket maximums and copays are being reviewed. Many of these plans are doing. The pre-65, they're keeping virtually the same plan as the actives had, and we're seeing a little bit of movement there, but not much. Post-65, we're seeing quite a few changes. Some are going to HRAs, and I think GMEPS has a policy where they've facilitated the movement to HRAs. They don't actually administer them here, but they've got somebody who will administer them for you. But we're seeing a lot more movement post-65 than pre-65, but there are some benefit design studies going on. We are looking at funding scenarios, including trying to set up some trusts. Typically, our city plans are too small to self-insure here, but that is happening in some instances. Carrier and administrator evaluations going on with those. Some delivery, I call these delivery platforms, the various DBE versus DC plans, so the HRA versus the typical plan that we've had in the past where you promised a benefit and not the contribution amount. Medicare supplement versus Medicare Advantage plans, or private versus public exchanges, all kinds of talk about delivery platforms. Again, I'm not suggesting you be a leader here, but I think following what somebody else has done here makes good sense for some of these plans. And the movement from DB to DC, that is to an HRA for post-65, appears to be pretty strong, and we have some examples if you'd like to follow those. The last thing that we've seen is discussions about who is not currently, who is first off eligible for Medicare, those that are over 65, and in our DB type plans, and they're over 65, they're not currently in the Medicare plan. What are they doing, and how some of the techniques we're seeing to try to get those people to go ahead and sign up for Medicare are rather interesting. And then there are participants that are not eligible for Medicare, and that's typically, I think, some police officers, that's the case, and trying to figure out what we're going to do for those people and try to get them at least covered by parts of Medicare. So we are seeing lots of discussion about these participants. They are a major portion of the post-65 liability. Their liabilities can be 4 or 5 or 6 times as big as those people that are eligible for Medicare, so there's lots of concern among plan sponsors here. If you're looking for a guide, Atlanta has done a lot of work. The city of Atlanta has done a lot of work with these post-65 participants. But we've also had some others in the GMEP system talk with us about, well, what's a simple way for us to handle these kinds of things? So let us know if you're interested in talking about this. My last prepared slide is right here, and that is what should we do? And I think discuss some of these implications with city finance. If you'd like to talk about timelines, please let us know about when you're going to need some of these new disclosures. And in particular, if you have a timing, we're hoping to work on these the first batch of disclosures under GASB 75 that would be required for the June 30, 2018 financials. We're shooting to get those to you in either April or early May. And if you have different timing, please let us know if you're going to be requiring different timing. Please confirm that there aren't no allocations required. If you have other allocations that you're doing to entities, please let us know. Maybe collect some information about the authority to set these funding policies. Remember that we can only help you with the tables that go in here. There are certain things that we can't help you with regard to funding policy and the ability to make changes. If you want sample disclosures, we can get them for you. In particular, this might be necessary, might be something that those people that have, those cities that have, I guess we had one measurement date that's one fiscal year end, it's March 31st, so that's quite a bit out there, and so that they won't be required to disclose under the new funding policy until I think it's June 30, March 31st, 2019. So you might need to see some new sample disclosures well in advance of that, and then at least consider pre-funding. We think that there's quite a bit of benefit to pre-funding with regard to the discount rate and the benefits that will end up being on your books, that net OPEB liability. So if you've got any questions about that, be glad to talk to you. Again, GMES can help out with that. With that, we're about at the end of the time here. We have some maybe 8 minutes or so that we have of time. Mike, you want to go ahead and open up the lines?
Thank you, David. It was a very helpful presentation. I'm sure useful information. So at this time, everybody, if you have any questions, please feel free to go ahead and text those in for us, and we'll see about getting you some prompt answers, or about getting you an answer at a later time if necessary. So if there are questions, please go ahead and enter those now, and we'll give you a minute to get that typed in.
Looks like Sharon's asking something. Oh.
David, is there anything, while we give them a few minutes to ask some questions, is there anything maybe you would like to touch on that you haven't touched on so far at this point concerning the GASB 74 and 75 changes, or maybe you'd like to put some special importance around anything we might have discussed here, just as a FYI? This is, some of the takeoffs that you may need to take out of this webinar, and if you don't take anything else, what's the most important items that you've discussed here that would be helpful?
Yeah, I think there are two things that I'd like to highlight, and that is the first, how big that net OPEB liability is going to be, and it's bigger than the actuarial accrued liability was under the prior standard. So if you had a $10 million actuarial accrued liability in our last valuation, you're liable to see something that might be as high as $12 or $13 million under the new accounting standard, and that $13 million will replace what was in the past maybe a $4 million net OPEB liability. So that entire amount goes on your financials, and that's a huge difference that I want to make sure everybody's aware of, and that you've at least identified with your city finance department. The second thing is the timing, and some of these timing issues are rather touchy, and I want to make sure everybody has a good idea about where their timing is and which CAFR they're going to have to use for GASB 75, and whether or not you need evaluation prior to that. So we've reached out to a few entities that we think need evaluation before the June 30, 2018 disclosure date, and we think that date applies to that. I think most of the other entities still have a good bit of time.
Okay, David, we have a question here from Sharon. We have June 30 year end. Will GMA be sending something out for information about engaging Segal for the data we need.
Okay, so with the accounting timing and with the valuation timing, let me go back to those pages. Down here. If you have a June 30 year end and you have a valuation date that's prior to, I guess it's actually January 1, 2016, then you're going to need a new valuation. And then you're going to need one pretty quickly if you want to get your the tables for your CAFR prior to fiscal year end. If you have a January 1, 2016 valuation date or later, and you have a June 30 fiscal year end, we won't need to collect new participant data, and we have something in place to, as far as measurement dates or reporting dates. So again, we're suggesting that you have a June 30, 2017 measurement date based on your January 1, 2016 valuation date. That's right here. If you have a January 1, 2017 valuation date, we can actually use this for 2 years. And if you just want to keep your same funding policy, that ARC, to replace your ADEC, to be used in your ADEC, your actuarially determined contribution, your funding policy, if you will, we'll go ahead and use what we've done in the past right here on these reporting. So there's no selection of discount rates. There's no selection of funding rates. We're going to use what we use for the pension plans for those that are funding through GNFs. It is, as long as you're comfortable with these measurement and reporting dates, I think those selections are fine. And so we're going to go ahead and continue to do these biennial valuations, evaluation every 2 years, and do interim updates that reflect these measurement reporting dates. So specifically, if you have a January 1, 2016 or a January 1, 2017 valuation, we have all we need for this June 30, 2017 measurement date, which will go on your June 30, 2018 CAFR.